In the third quarter, the US economy finally picked up speed. Growth surged, mortgage rates dropped, and the Fed made its first move in months. Trade tensions also began to ease, giving markets some breathing room. But behind the progress, signs of strain are starting to show. Let's break down what really happened and what it all means for mortgage professionals like you. After a weak start to the year, the US economy made a strong comeback. According to the Bureau of Economic Analysis, GDP rose by 3.8% in the second quarter, marking the fastest growth since late 2023. That boost came mostly from lower imports and higher consumer spending. Investment and exports slowed a bit, but not enough to derail the rebound. Still, not everything is moving in a positive direction. The labor market, for example, is starting to show cracks. While the unemployment rate held steady at 4.1%, job creation slowed sharply, dropping from 147,000 new jobs in June to just 22,000 in August. It's not a collapse, but it's definitely a shift. And inflation? It's heating up again. The consumer price index climbed to 2.9% year over year, pushed higher by rising import costs and a weaker dollar. That's well above the Fed's 2% target, and it made their next move a tough one. In September, the Fed made its first rate cut in 6 months, lowering the federal funds rate from 4.5% to 4.25%. It's a clear pivot toward easing. But with inflation still sticky and demand rebounding, this move could reignite price pressure. The Fed made it clear, future decisions will be guided by incoming data. Meanwhile, the housing market finally experienced some relief. The 30-year mortgage rate fell from 6.88% to 6.34%, giving borrowers a reason to re-engage. Mortgage applications jumped by 47.5%, with refinances leading the way, though purchase activity rose too. Still, growing inventory and buyer hesitation led to slower price growth. The house price index rose just 2.3% year over year by the end of July. So what's next? Analysts expect consistency through the end of the year, but there's also a warning about a possible second wave of inflation. The Fed may cut rates again, potentially twice more in 2025, but only if the numbers support it. For brokers, that means more rate conversations, more opportunity, and a more active market. One thing's clear, rate cuts are back and the market is moving. Subscribe to AD Mortgage to stay ahead of the trends, track the shifts, and help your clients win in any market. We'll see you next time.